I'm going to ask you, if you don't mind, to please give your undivided attention to Steve Greenfield, who's going to moderate this panel. I'm so thankful to Steve to be here. First of all, he's an amazing guy. I just love his aura, and to talk to him and listen and see his newsletters and all his intel reports, and it's just fascinating. So please, I think it'll be worthwhile. We will wrap up fairly, quickly, probably at the top of the hour. If you have a question, I'd ask that you raise your hand and you wait till we get to you with a microphone so everyone can hear the question, because I'm sure it'll be thoughtful and it'll be important for us to hear it. So thank you again for paying attention and for being here. And then I'll come back at the end just for a minute or two to wrap up.
Thank you, Andrea. So I'm just trying to make sure that I can see everyone. Sorry for folks that are behind the pole. You'll have to actually let me know with some audio if you ask a question. So we're here for you. I'm certain, given the quality and caliber of the folks who are up here today, there will be questions throughout. So don't hold back. No reason not to sort of, if something's said that you either don't agree with and or you want to get some clarifying questions, please don't be shy. I don't imagine with this audience anyone in the room is going to be shy. I'm also the runner. I'm going to moderate and multitask and try to get the mic to you as well. So just raise your hand, shout out if I'm not paying attention to you, etc. But let's dive right in. So let's start with context setting. If you guys don't mind, well, thanks for being here today, by the way. Thanks for making the trip in, really appreciate it. So Jeremy, maybe we'll start with you. For each of you, if you wouldn't mind, give the audience some background, what you're working on now, and context before we get started.
Sure. So you want to use our own mics? Or?
Please.
Good morning. So I'm Jeremy Alacandri. I'm here today to talk about different automotive retail issues. For a little better understanding, I spent about 10 years in automotive retail, was involved with some of the committees at NADA, and then spent about the past 8 years in consulting, working for companies like Deloitte, PwC, and my former partner was Marianne Keller, who spoke at one of your events a few years back, who I'm sure you know. And to just echo what Andrea said about Steve, I do know some of the senior executives at Cox Automotive, which just everybody knows is a huge conglomerate of a company, and they said that Steve was the hardest working employee while he was there. So I want to give him
It's a pretty low bar. It's a low bar with Cox. So if you know any of the Cox people. Todd.
Just see if this thing works. Hello? Yeah, it does. My name is Todd Burko. I'm a co-managing director at Bel Air Partners. Right now, I'm working on a couple of buy-sells, doing valuations for dealers for bank financing, estate planning, things like that, and I've done a few legal work too. So essentially, we just do financial analysis for dealers and basically either help them find new dealerships or sell a dealership.
Great, thanks. Kevin?
So I'm Kevin Tynan from Bloomberg Intelligence. I started in the late 90s out of graduate school on Wall Street covering the auto industry. And in 2005, I downgraded all the manufacturers to a sell, said they were going bankrupt 2 years, 5 years, whatever, and in 2009, it all happened. Then Bloomberg recruited me to start the auto coverage in-house, which is the unit called Bloomberg Intelligence. And essentially, it's the same thing, right? I'm not making stock calls anymore, buy, sell, and hold, but I'm writing investment-focused content regarding the auto manufacturers, the suppliers, the retailers, and even retail auto parts. So very vertically integrated into the auto space.
All right, let's dive right in. So maybe, just projecting, if I was in the audience today and I owned a bunch of stores, I might be obsessing around profitability. We've come off the last 3 years where we've had record profitability for dealerships. As you look out the next 12 to 18 months, how do you think it's going to play out in terms of profitability for the dealer channel specifically? Go ahead. Anyone like to take a mic first?
All right, I'll start. I think that the next 12 months, what I've been saying is that your EV plans from the automakers, if there's not a significant improvement in profitability and demand profile, you're going to start to see manufacturers walk back some of those targets that were, I think, more of a dart throw at the beginning.
The aggressive EV targets they have.
Correct, yes. Because ultimately, they're not profitable, right? And as a manufacturer, you're not going to produce what isn't profitable. This is not about consumer demand or, what Twitter says. It's basically as simple as if the consumer has a federal tax credit or a rebate and the government's investing in infrastructure and a manufacturer looks at their income statement and says, I lose $15,000 per unit, it doesn't matter. I'm not going to build it. And so that's what this past, 5-7 years has been. And I think the next 12 months, it'll be more traditional auto supply and demand balance. Inventory needs to stay in control. So, looking back, it would be 4 million units on the ground to sell between 1 and 1.5 million. Now it's about 2 million on the ground, 2.3, whatever. So that ratio is much better. But if that gets out of control, you're going to start to lose some of the pricing power that goes forward. I think it's inevitable. But I think that the automakers have also seen what supply and demand discipline and balance looks like, and it's very profitable for everybody. So my view is that the motivation is not to start overproducing again. Cost structures have been rationalized. We can live at a 15, 16 million unit market at $48,000 ATPs instead of 17.5 at 35. Because the revenue pool is actually larger in that scenario. And people looking at it saying, yeah, but you're down 2 million units. That's not the point. The point is the pool and the profitability and the margin.
So let me mirror back. So you're saying profitability is going to drift downward, but not go back to the levels it was before.
Correct, yeah, because, we had a full year of, and you guys know, right, over MSRP, consumer pay, because of that supply-demand balance. That's not sustainable either, right? But neither is 4 times the inventory for the number of units that you're going to sell in a given month. So right now, we're kind of in between in a sort of sweet spot. I would say that the market going forward would look more like it does now than it does at either of the extremes, pre-pandemic or during the pandemic.
Okay, great, Kevin. Todd?
Well, I would just, to amplify certain points, I agree with him. What I would add is that what's being differentiated more is brands. Certain brands are profitability is gonna come down, but the profitability on certain brands is gonna come down less quickly than others. And it's gonna be linked to inventory, tight inventories. If you had a franchise that was making $500,000 and then was making $3 million because everybody else was sold out of inventory and you had inventory, well, your profitability is going to go down a lot if you're selling, your competitor's selling Toyotas, and all of a sudden the Toyota guy now has inventory where he didn't have before. They're not even going to come to your door. So I think certain brands, the inventory is going to come down.
Which brands do you worry about?
I worry about the mass market, import mass market, other than Toyota, Honda, and Subaru.
Not to mention any names, right?
Well, you asked me to. I mean, what's an opinion without a name? And the other point is on Kia and Hyundai, they've been doing great, and the brand's getting higher recognition. I just want to see what happens when the world happens with too much inventory. And I think one of the things now is we're at a point now where manufacturers have more control over dealership profitability than they've had in the past 20, 25 years. And that's because of inventory. So if you tell me what your profitability is, if these people keep it between 15.5 and 16 million car production, I think we're going to be profitable and it's going to be great, and things are going to make 2019, which is everybody's benchmark, look cheap. However, if they decide that they have to make 18 million cars, we're going back to 2019. My personal opinion is that we're going to be on average 20 to 25% higher than 2019 going forward. And the other piece, not to go on too long, is the microchips, which is, as you know, the shortage has been a problem. Well, one of the problems with microchips is that 20 years ago, the microchips in a car were at a ranking of 1 out of 5 or number 5. Now, cars are getting so sophisticated that they're now using advanced chips, and now they have to build new plants for those. So a lot of the profitability and a lot of the production is going to be linked to these chips and when they become available.
Thank you, Todd. Jeremy, thoughts on profitability?
I think Kevin and Todd covered everything. The only thing I would add is that there's still a tremendous amount of pent-up demand in the market. So even if we do see the supply constraints make it, more, make inventory more available, there's still significant demand for the foreseeable future to make up for that.
Yeah, and if I can, just really quick, from a manufacturer and even a retail perspective, it's a lot easier to sell 15 to 16 million than to 17 and a half, 18, by throwing money at the problem. But again, the costs have been rationalized to the point that it doesn't need to exist in that space, right? You had, as far back as the bankruptcy period, right, where you had jobs banks and you had healthcare for life and you had pension, and all those were wiped out in the bankruptcy period. So this has been actually a long walk to this level of fixed costs that makes it manageable at a much lower level. So, just simple business economics, you're just not going to sell as many things at 48,000 as you did at 35,000, right? It's as simple as that. But the revenue pool is actually much larger, 15 and a half times 48,000 versus 17 and a half at 35,000, right? It's actually a $100 billion difference. But if you're looking at the volume number, you say, oh, the market's rolling over, but it's not. The pool is actually bigger.
And I would add one thing about the whole idea of pent-up demand. We've done some work on that, and we ran one model that said, hey, look, you got pent-up demand, and for the next 2 or 3 years, they can produce 17 million cars, and you get good grosses. Now the problem is you're making 17 million cars, and somebody says, oh, next year you got to make 15.5 million because you're run down, and will manufacturers have that kind of discipline? The other thing about pent-up demand is that there are now more cars on the road now than there were in 2019. So the question is what is the real number of pent-up demand?
Let's switch gears. Dealership valuations, also I would imagine, pretty top of mind for a lot of people. Todd, maybe I'll start with you. What's happening right now versus, say, even 6 or 9 months ago with valuations? And then I'll ask you to go out, on the plank and forecast the next 6 to 12 months.
When I talk to lawyers who process these deals, they're seeing a reduced volume of third-party deals. They're still doing within families, but they're seeing a reduced volume. I don't see, the market to me is always good. It's what the bid-ask spread is. So with interest rates going up and banks becoming tighter, that bid-ask spread is starting to widen. So things may be slowing down a bit, but dealers are still aging. Their kids still want dealerships. All these things happen. And the buying and selling of dealerships, while everybody focuses on the financial, is really emotional. Do I still want the dealer lifestyle? Does my kid want the dealer lifestyle? Do I still enjoy my job? If you're enjoying your job, it's like your house. If you like your house and you're still living in it, you don't care what it's worth. You're still living in it. But if you want to move something, you're going to figure it out. I would say going over time as the world digests these higher interest rates and we get a little bit more clarity on what the manufacturer production is going to be, I think the buy-sell market is going to remain strong and probably tick up because dealers are still aging and people's circumstances still change.
Are you seeing anything interesting, either positive or negative, with private equity interest in buying stores?
Private equity is probably getting, they've always been more price disciplined than a dealer because that's what they do. A dealer will see a franchise that they've always wanted in their market that they gotta own, and they'll go up 20% to buy it because they're buying this for a 20 or a 30-year asset, not for a quick turn. Whereas a financial buyer says, well, the ROI doesn't hit my target. So I think they're interested, but they're much more price disciplined, and I don't think they've been pulling back, but they're gonna show a little bit more discipline. I think the private dealer right now, one of the things we do is we, as a sort of a template or as to look at what the financial buyer is doing, we calculate the blue sky multiple of each of the public companies. And 3 years ago, it was like at 4. Now it's at like 5.5, 6. So I think the private dealers are basically going to outperform some of the financial buyers because they want to own the dealerships. Particularly if you look at Florida, where everybody wants to own a dealership. People will bid up the prices beyond what financial buyers do. You're going to look for a turn or a turn and a half higher in Florida. So it depends upon the market, but I still think it's going to be robust.
And what are you seeing in terms of real estate, sale leaseback? Is that becoming more or less popular?
I think sale leaseback has been somewhat declining and becoming less popular because people who did sale leasebacks did it because it was a source of financing. Well, with everybody making as much money as they've been making, they don't really need that financing as much as they used to. Plus, and don't tell anybody who does sale leasebacks that I said this. The problem with the sale leaseback is you sign a 15-year lease, and at the end of that 15 years, you may be paying above market for that lease. And the reason is twofold. First of all, they have CPI adjustments every year, number one. Number two is the manufacturer comes in and says, you have to put $5 million into your facility. And the sale leaseback guy goes, I'll give you the $5 million, but your rent's gonna go up, so I can get my 7 to 8% return on it. Well, you may spend $5 million on your facility, but really only $2 million of that increases the value. So technically from day one, you're overpaying on your rent. So people are seeing that. So at the end of these leases now, you're gonna get a clash where somebody's gonna say, you either lower my rent or I'm gonna move. Now here in Jersey, it may not be that big a deal, but if you're in the Midwest where there's plenty of real estate now, it becomes a contentious problem. And even here it does. So I think people, when they have the money, tend to pull back from sale leasebacks.
Great. Kevin, Jeremy, any perspective on valuations, dealership valuations?
That was awesome.
Okay, there you go. So I'm going to stay, Todd, stay with me here. So it's a one-on-one, Todd, let's go.
Sorry about that.
No, it's great. So help us understand, you kind of hinted at this. What do you see in terms of dynamics that are changing on a brand by brand basis? You know, I hear anecdotally like, dealers are, selling their grandmothers to buy Porsche stores. They'll do anything to buy Porsche or Toyota, whereas, Mazda stores, for example, are lamenting right now. What are you seeing in terms of things, and if any movement that surprises you?
No, but I think that it depends upon your market, okay? You can sell a Mitsubishi dealership in Florida, okay? I don't know if you can sell one in New Jersey, okay? But there are certain dealerships that people lust after, and the value of those are going to maintain. So they would actually sell their grandmother, their firstborn, and their grandchild for a Porsche store. Land Rover, not so much. Mercedes, BMW are down from that. But you're still talking about multiples that are very high. And people are pushing them up. But, Mazda, second-tier franchises, people are less interested in those because it's less of a stretch.
And what do you consider like a second-tier franchise?
I'm not getting it.
Come on.
I'm not doing
You can't
that.
say that to me and not deliver. All right.
I just want to make one other point, since we're picking on Mazda, okay?
I opened the door there.
Right. They still have value because you have to remember, all you folks own new car dealerships, right? But if you're a used car dealership and you see a shingle out there and you can get the benefit of a franchise at a Mazda dealership versus Sammy's used car lot, or I can get access to the manufacturer's finance company, that's worth money to you. So every franchise has value, and yes, you can sell a Mazda dealership in New Jersey. You may not get the price you want, but you can sell it.
Okay, great. Kevin?
Yeah, no, I think, to your original question, when you look at where average transaction price is now, you kind of, at least the way I think about it, there's those that are above, and then there's those that are below. And below that average transaction price, it gets very difficult to be profitable as a manufacturer. And let Todd handle all the dealership stuff. But from the perspective of the manufacturer, it becomes it's about scale, which is what the industry used to be, right? Very, very low margin, if any, and a lot of volume. And the market here in the U.S., and what I'm saying is going forward, is going to be less about just scale for scale's sake. It's going to be about moving up market. You look at General Motors, ATP for them, of the 4 brands.
Average transaction price.
Yeah, sorry. Would nobody know that?
I don't know. I didn't know that.
Okay. It's like over $50,000, $52,000, $53,000. Same thing with Ford, because it's so truck heavy right now that, they're above average brands now, right? And so everything below that average, and it's just a fuzzy guideline, but it's just harder to make money down there right now.
All right, so we talked about profitability, talked about valuations. So I'm going to look to you. Before I move on to the next topic, I'm sure there's questions in the audience. You have no questions about profitability or valuations. Come on, you're killing me. We got a question here.
Impact of EV
Well, we'll get to EVs in a minute, but, okay, good, impact on profit, so let's go there, let's go to EVs.
Yeah.
This is a juicy one.
Yeah, it's the opposite of profitability.
There you go. Drop the mic.
Look, and I've said this for years, and I think, you know, what's interesting is I think that there was, if I'm going to be like really conspiracy theorist here, right, the tweets of one crazy billionaire sent us off on this course that media, the stock markets, the governments, and competitors all believe some of the mythology of the profitability of EVs, right? And we go down this road, and I think we're now in this window where everybody's going like, hey, you know what? This isn't what we thought.
So Kevin, let me pause you there. So why is it that Tesla is printing higher gross margins? Can you walk us through that?
Well, one, you have regulatory credit sales, right? So they get credits for being zero emissions.
Carbon offset credits.
Right, offset. So they sell it to other automakers. So I did the analysis for the third quarter. So there's a couple things, three of them that I can name right now. And this is at the gross margin line. So you say you have regulatory credit sales, which I think I calculated to be about $1,200 per vehicle. Let's say they were profitable in this most recent quarter at, I don't know, let's call it $4,000, $5,000 per vehicle. I think it was $1,200 was regulatory credits. They also take deferred self-driving revenue off the balance sheet. So Tesla sells the consumer full self-driving, which technically doesn't exist, and charges them $12,000 or $15,000 for it. But because it isn't really a thing, some of that money gets put on the balance sheet as a liability. Then, as they send an update or make progress in it, they take money from the balance sheet and put it into revenue, which they can do basically.
Sounds a lot like Enron.
Yeah, sounds like. and it seems like they can do it at their own discretion. Like, what do I want my gross margin to be? Like, let's call in some FSD revenue. And then the other thing is this, and I went through, there's this filing called DEF 14A, and it's basically like the CEO compensation filing, and everybody compares their ratio to, and that's what the union is going like, Mary Barr makes 382 times that. But I looked at the median employee for each of Ford, GM, and Tesla. So Ford was 74,000. So they line up all the employees, they find the median, and then they apply what they do for executive compensation to that employee, and you get a number. For Ford, it was $74,000 last year. For GM, it was 80. Anybody want to guess what Tesla's number was? Anybody? Shout it out. 34. So if you do that calculation at the operating line, it's over $3,000 per vehicle. So now you have, you know, basically the
So he's scared of the UAW.
yeah, and that's what I was saying. That's why when I was publishing on this, I was like, here's what's going to happen is that that GM, Ford, everybody else, Stellantis brands are going to give a big number to the union, but nothing else. You're not getting pensions, you're not getting, but take this big number and go show it to, you know, Marysville, Ohio, and Tesla and Rivian and Lucid and all these transplants and pure plays and tell them what you did, because it's a profit, it's a margin disadvantage to them. But basically what I'm saying is that Ford and GM will never have Tesla's profitability. And people think I'm saying that because Tesla's so wonderful. It's like, no, because it's kind of made up.
It's a shell game.
Yeah. So, so when you really look at profitability of EVs, it just doesn't hold up. And I think we're in this window right now that is like, another example would be the direct sales model, right? I think Rivian, Lucid are looking at that and going like, what did we do, right? This doesn't work, especially at scale. And the reason why, and there's an accounting reason, and it's working capital shift, but if you produce something, if you're Lucid and you produce something, you pay your cost of goods. If you don't have a dealer network, you don't book your revenue until you sell it to the consumer. And Lucid has like quarters where they deliver 60% of their output. In the third quarter, Lucid, at the gross margin line, was unprofitable by $200,000 per unit. Wow. At gross, right? Rivian was, I don't know, 80-something or whatever. So if you don't have, now you can book the revenue and it can sit on your lots for 90 days, but the revenue's booked. So as an investor or as an analyst, I know what your gross margin is going to be. right? But if there's a slowdown and now you can't deliver your output, now your gross margin goes through the floor, it goes wildly negative. How does anybody invest in
Which
you?
is pain Tesla's starting to feel now, correct?
Correct, yeah. So what they did was, Tesla's third quarter, they actually delivered more vehicles than they produced by 4,500 units, which is the first time in a long time, but they cut production sequentially by 50,000 units. So they have to ensure that they can deliver everything that they build. Otherwise, their gross margin myth is just shattered. So they were able to do it. Where it's going to be a big, big problem is if they cut production, lower prices, and they still can't deliver everything that they produce.
Okay, so you opened a Pandora's box.
Yeah,
We're going
sorry.
to continue to go there. I'll get you in a minute. So while we're on EVs, so now rewind the clock 18 months ago. Jim Farley and Mary Barr are up there saying, EVs are the new panacea. We're going to go 100% EVs. It's the future. Blah blah blah. We want Tesla's margins, which may or may not exist, to your point. And now they're starting to walk back, right?
Yeah.
So talk a little bit about Ford was estimating $3 billion loss this year in their EV division. Now they're up to 4.5.
4.5.
Maybe it'll be higher by the end of the year.
4.5. So that to me
So
is,
the legacy OEMs are bleeding
Yeah.
in their EV divisions. Is there ever in the future going to be a profitable Ford EV division, or how do they stymie some of that and get
Yeah.
that back in balance?
well, the idea would be scale, I guess. And then this idea that battery costs, which, by the way, there's 6 times the amount of raw materials in an EV battery as there is in an internal combustion engine. 100% of that mining and supply chain is controlled by China, so I don't know how costs come down indefinitely in that scenario. But it's interesting to me that every single automaker, legacy or pure play, is bleeding money on EVs except for Tesla, right? So is it like they're so smart that they figured it out, or are they just better at burying the bodies? So I don't, and I've asked a lot of people, if you look at Ford is a good example, right? They reported a $37,000 per unit loss in the third quarter per EV, $37,000. Ford Pro earned $5,300 per unit. So I asked people, well,
Ford Pro being their commercial division.
right? How is there ever an example in any industry, autos or otherwise, that you go from so wildly unprofitable to even mildly profitable? And most of the answer is no. That even at the beginning of the auto industry, when the Dodge brothers were building cars for Henry Ford, day one profitability, right? And that's a key thing that I've been thinking about lately is day one profitability. The mix shift to truck from car in 2013, first day profitable, right? EVs, year 10 profitable, who's going to wait around?
I just have one quick question. Sure. When you look at Tesla, and they're screwing around with the accruals and everything else on the balance sheet and the income statement, what does their cash flow look like?
Yeah, they report positive cash flow.
How do you report positive cash flow? The money in the bank has got to be going down under your scenario.
Yeah, but they can raise capital, and you have.
I'm saying exclusive
Oh.
cash flow from operations.
Well, they rein in CapEx. There's levers to pull.
I'm saying before that. In other words, cash flow from operations. What's that looking like?
I don't know the number for the third quarter off the top of my head. It's positive, but it's going down.
Okay, that's what I'm asking.
Yeah.
Because as you well know, an income statement says what your opinion is. Cash flow is what you actually spend.
Yeah.
So did we get your question answered, sort of?
Well, I was going to ask on the used car side, does Tesla report the number of vehicles that they're leasing, and what are they doing with their off-lease vehicles, and are they hiding some accounting issues when they're disposing of those used leased vehicles?
Great question. Everybody heard that, I think. Go ahead, Kevin.
Never. Come on.
You can hide a lot of stuff that way.
Yeah. So they couldn't have a financing unit. Nobody would write leases in the early days, so they do it in-house themselves. So there's a lot of things we deal with, like there's no IR department. So a lot of these
Investor
things.
relations. So
Yeah.
you called, there's nobody to answer.
There's nobody to answer, yes. So nobody, and he won't answer these questions on the conference calls. So really, we don't know. You have to kind of do your own digging, but it's hard to find some of these things. So I don't really have an answer on what he's actually doing on the used car side. But those vehicles go on their books because there's a guaranteed buyback price.
Other questions? Yes.
Kevin, one of the important things I think that Tesla's done is build scale. So you see Tesla, whenever they feel they're being threatened, they reduce their prices because they've got operating scale.
Right.
And that's what's happening. My question really is, UAW, what's going on with the UAW and how's that going to impact the dealers? And the second question is, we've always known that they're going to lose a lot of, legacy players are going to lose a lot of money making, trying to make
Yeah.
battery cars. But do you think the government's going to come in? And one of the issues is the government has determined that we're all going to be driving battery cars. That just means the legacy guys are going to lose more and more money. Is the government going to come in and subsidize the manufacturers?
No, and they should have by now if they were going to. But this isn't China and it's not Europe, right, where the government is either penalizing or subsidizing the manufacturers. BYD in the early days, like 2013, 2014, when China wanted to move to EV, was getting $44,000 per EV, direct subsidy from the government.
Chinese government.
Yeah. So that would be weird if our government.
You don't know what the Democrats are.
So our government would never do that, right? What the closest thing we're going to get is that the federal tax credit is going to become a rebate at the point of sale, and then every automaker is going to raise their price by $7,500. And we'll launder money through the consumer, through the dealership, and back to the automaker. But they will never go directly between the two. But we don't have our government here doesn't have the appetite to subsidize the way China does or penalize the way that Europe does. And I think what winds up happening is that the government has to walk back the targets. They're not going to turn the screws on the manufacturers saying you have to do these unprofitable things.
So let's talk about the UAW. The first part of Sheldon's question was UAW. What impact is it going to have on Tesla and Toyota?
Yeah, I did the analysis on the increase in the hourly wage. By 2028, it's $500 in labor cost of goods per vehicle. $500.
For Stellantis, Ford, and GM.
Yeah, basically $500 in your cost of goods, or the labor portion of your cost of goods, which, if you look at this mix shift I talked about to truck from car, average transaction price has gone up like $12,000 in the past 5 years or whatever it is. So in terms of absorbing that $500, it should be reasonably easy.
And we've seen Toyota, Hyundai this morning, I think, already
Honda did
raised.
it.
So, I mean, they're being proactive
Correct.
to defend against the threat of the UAW coming in.
Correct, yeah. So there will be either cost levers or revenue levers to pull for manufacturers to absorb that $500. And again, that $500 is 4 years. That's at the end of the contract.
Other questions before I move on? Next, I'm going to move to the agency model. So anything before we move on? All right. Well, I guess while we're on EVs, I'll ask this question. This will be a curveball for all of you. If you were a dealer in the audience today, would you be raising your hand for a VinFast franchise?
Can we actually see people raise their
Well, yeah. Who is interested right now in a VinFast franchise? Okay.
Or any small Chinese EV manufacturer?
Or NIO. VinFast is Vietnamese. And NIO, this week on Bloomberg, I saw they're contemplating a franchise model in the U.S. as well.
Right.
That's a Chinese manufacturer that does battery swaps. Interesting. You won't have to charge. You can battery swap. Anybody interested in a Chinese franchisee?
What about Rivian and Lucid?
If Rivian or Lucid want to create a franchise, these guys might not want to reveal that. We got one over here. Okay.
Yeah, that's what I thought.
So, I mean, your thoughts on this? I mean, would you be encouraging this audience to be open-minded around these things, or is their answer the right answer? We're not seeing any hands go up.
Well, I think it's changed from 15 years ago when everybody wanted a new franchise because everybody was looking for the next hot deal. I remember Malcolm, Sheldon, you remember his name. Malcolm Brooklyn. He was going to bring Chinese cars in, and I read the prospectus, and it looked like I wouldn't do it. But then again, dealers who were very smart said, hey, I'll do it. and they signed up. I mean, the car never came through. And then other people said, hey, look, I'll take the franchise.
15 years ago, the cars were really bad in China. They're really good quality cars now.
Right. That being said, you tell me what do they want for a facility, and I'll tell you if I'm interested in putting it up. If I can put one car in one corner of my showroom, that's different than if they want a $15, $20 million facility. So you got to work out the economics.
So you're not saying no.
I'm not saying no. You tell me what it's going to cost to get this thing.
Jeremy, thoughts?
So I don't have personally, I don't have an opinion, but I did discuss this issue with Mary Ann before she passed away, because we were comparing the rise of the Chinese automakers in the US versus when she was covering Wall Street as an analyst, and the Japanese were starting to come into the US market. And at that time, there's always this story she would tell me. She was speaking at Tavern in the Green in Central Park to a bunch of GM dealers. This is like late 1970s, and she was saying how the Japanese were going to come to the US and they were going to be a threat, and they were going to be a dealership that you would want to have if you were a franchise dealer. And she got booed, and she had to leave because the audience was so resistant. So obviously, you know what happened. Japanese came in a big way.
Well, the first generation of Hyundais were horrible cars. And look at them now.
Right. But, well, so to the question about the Chinese, she said that absolutely, if it was. And we were talking about ICE vehicles as well as EVs, if it was a respected manufacturer, and I think all the Chinese automakers for electric vehicles, for the most part, the major ones, are making vehicles that are comparable quality to Tesla. They've copied everything. So she would say, or said, yes. That's
Great.
discussion.
Thank you, Jeremy. Kevin?
I mean, I think, you know, because of the sort of working capital shift that I talked about earlier, like Lucid and Rivian are probably kicking themselves for not having created a franchise network. And I think, you know, what I tell dealers all the time is, like, if EVs were profitable, or VinFast is going to penetrate into this market, or any of the Chinese manufacturers, you'll know. You'll be the first ones to know, because you're who they're going to come to for these stores. I mean, it just
Well,
does.
it's happening now with VinFast, I think, right?
Yeah. I mean, it's the only way. The direct sales model just doesn't work, and I think that's part of the mythology that some manufacturers believed would work, but it's not scalable. So I think that the sort of Asia-based manufacturers that want to come in here will do it through the existing franchise dealer base. And by the way, Malcolm Bricklin was also Yugo. He brought Yugo here.
Interesting.
So, but you think about it from a historical perspective. I mean, how many used car dealers put the first generation Honda, the first generation Toyota in their used car lot, and now they become incredibly successful, well-respected dealers, and some of them couldn't get a domestic franchise back then. So, as again, you tell me how much it costs, and I'll tell you if I'm interested.
Great. So let's stay with the Chinese for a minute. Will we see in the next 5 years a $20,000 Chinese vehicle in the U.S.? And if so, how is it going to get onto American soil?
Yeah, that would be, you know, I don't know, but my point is, I don't think anybody cares, like, in terms of manufacturers here. If you want to sell unprofitable stuff at $20,000, you're not really taking much market share from the existing. You know, who are you really hurting by doing that, right? By coming in with a loss-leading $20,000 vehicle. You know, maybe down the road you're missing out on entry and move-up buyers. That wouldn't even be move-up buyers, you know. So the concept, or at least my concept, is not every sale is a good sale, you know. And if automakers could sell things they could sell all they want at $20,000, right? We talked about this before. Nissan Leaf, right? People talk about a $35,000 EV, and you know, that should sell in the hundreds of thousands, yet they sold 12,000 of them last year. Why? Because it doesn't make money, right? And it's as simple as that. So I think there's a lot of automakers that would say, if you want a $20,000 market to lose money in, go ahead, you have at it.
Well, are we going to see, you know, Tesla's announcement last week in Germany about a $25,000 Tesla, whether you believe it or not? Are we going to see a $25,000 EV from anyone anytime soon?
No, I mean, not unless you, like Tesla didn't care about losing money. They were rewarded for losing money. They get to a $1.3 trillion valuation for losing money. I think that world is over. So they could do it. They'll lose a lot of money doing it, and it might tear apart the story.
Okay, so let's shift gears to the agency model. We don't hear a lot about this anymore. I don't know what's going on in Europe right now. I know there was more of an aggressive movement. I think the OEMs were enamored largely because of Tesla. I know we belabored this maybe already, but any additional thoughts on OEMs trying to sell directly, own the consumer relationship, have consumers go to a website and pre-order vehicles, or are those days behind us?
Well, oh, I'm sorry, Kevin.
No, go ahead.
Well, I would say one should talk to Mr. Appleton. It's basically illegal in New Jersey, is my understanding. And I don't think a whole lot of states are going to try to make it legal. So I think that's the first hurdle we have to deal with. And secondly, I think one can just look at the Ford retail network and show how successful manufacturers have been with going direct to the consumer. So if you think EVs are uneconomic, I'm not sure that the manufacturers going directly to or using the agency model. And number two is, okay, who pays for the CapEx? That beautiful $30 million facility, okay, you want to give me a fee, but I don't have to pay the rent on it? Hey, that might be a good plan. But I don't think the manufacturers who've basically benefited by making the dealers build them beautiful facilities and keeping those assets and that CapEx off their balance sheet are going to want to put it back on their balance sheet and what the hit to earnings is. I just don't see that.
Jeremy, any thoughts?
I would just add that I think this topic before COVID was a big topic, and a lot of manufacturers were looking at ways to differentiate themselves besides product. And then after COVID, with all the supply issues we've had, and then adding the electric vehicle threat to their business models, they've just moving on. This is no longer a big thing for them.
Let's, Todd, I think you scared off Kevin there. I think he's left the building.
Sorry about that.
Not really, he's coming back. Let's talk about online retailing. Why haven't dealers, well, I mean, during COVID, a lot of dealers were forced to embrace online retailing. It was the only option in some states. But now we've had a couple of steps back. Why haven't dealers embraced online retailing even after COVID?
So I'll jump in because this is something I'm actually researching right now. One of the big challenges I've heard from dealers is that because of the supply constraints, they don't want to put transparent pricing on their website. There's really no interest to go back to or go to a very visible or transparent model. It's more about how much gross we can make on what we have. Some buyers, for example, will go into dealerships still expecting to pay more than MSRP, so why would we put that information up front? Where some dealers feel, there's an example from Dar Cars where they're selling that Hellcat, that two-door Challenger, whatever it is, Hellcat for like $125,000 over MSRP, and the picture went viral of this sticker. And so there's resistance by the dealers really to embrace it, A, because they're concerned about their reputation, B, they also figure out why do we even have to? We don't have enough to sell. We want to be able to go back to, just maximizing gross based on getting it up. And so I think without automakers actually pushing this, we're not going to see full transparent retail, or at least I'm not seeing it in a big way. And by that I mean, a consumer can go to your website, see the price that they're going to pay for the car, see the F&I rate, get all that information upfront with ever actually going into the showroom. Like you go to Amazon, you know what everything's going to cost before you ever buy it. And that level of transparency, we talked about it, automakers have talked about it, Lexus experimented with it, some dealers have tried it, and some dealers are still using it, but for the most part, dealers are not embracing it. And it is surprising because you did think after COVID that it was going to happen. It seemed to make sense, and it hasn't happened, at least at scale. So that's just what I'm hearing, and I don't know if you guys.
What I would say is, why do you want to turn what you're selling into a commodity? Commodities are a race to the bottom in terms of gross. You want somebody in your dealership, you want somebody to show how your dealership is better than everybody else's. You want to introduce them to the service writer, because you have to remember, you just don't sell a car, you service a car. And if he's buying it online and he's getting the cheapest price, what are their incentives to use you for service? So it's part of, a car dealership is not one business, it's 5 or 6 businesses. And to basically put one piece online and have no relationship with the customer, I don't know what retailer doesn't want a relationship with their customer in the car business or anything else, and you get that by having them come into the store.
So Todd, just so I understand what you're saying, so if you were running dealerships, you would not post prices transparently online?
I would, basically, if I were owning a dealership, and I'm not competent to do that, I would say, I want to get people, I want to get foot traffic in my store. I want to use my website and all my social media to drive people into my store so I can show them what a great dealer I am.
So you'd have a call for price?
No, I'm not saying that. I'm saying that's my goal. I'm not smart enough to figure out the proper strategy, nor would I tell anybody here what the proper strategy is. But what I'm saying is that you want to avoid being a commodity. The cars that are commodities have the lowest gross margins per car. The cars that are aspirational have the higher gross margins per car. I want people to want to buy my car, not to go online, talk to 10, send emails to 10 different people and just go with the cheapest guy. I want to show people how I can add value and to get people into my dealership.
So Jeremy, same question for you. I mean, if you're a dealer, how do you balance being transparent, which is what consumers want across other categories outside of automotive, and not forcing a race to the bottom?
Well, I'm not a dealer. I'm a used car dealer technically, but it really varies by franchise. I hate to use that excuse, but depending on what you're selling, you really may be in a situation where embracing this type of model for the reasons that Todd pointed out don't make sense. But there are other benefits as well, depending on your market, depending on, again, the brand, depending on who your customers are. I mean, the experience that we would like, where we can get someone to come in and we can have them sit in the dealership for 4 or 5 hours and try and, maximize every profit center is desirable for dealers, but the consumers hate it. I don't know if any of you have actually gone to a car dealership and tried to buy a car. I have, and you go through the whole racket of, them trying to sell all this stuff. And I tell people my background, and they still, try and do it. I have some great stories. But yeah, I mean, it's something that each dealer that has to, see what their comfort level is and see if it's something that they want to embrace. And another important thing is used cars and new cars are different. So your used car strategy, how you price them, obviously should be different than your new cars. Because the consumer's different and pricing, commodity, and all that stuff.
I just want to say, I'm not suggesting you make somebody spend 4 or 5 hours in the dealership. I mean, if you can get them in there for 15 minutes and build customer loyalty, I'm all for that. I mean, when I bought my last car, I was in the dealership for a half an hour, came back the next day and picked the car up. It was efficient, it was clean, and I love my dealer. And the point is to build customer loyalty. And keeping them in this dealership for 6 hours doesn't build customer loyalty. And putting them in the box doesn't necessarily build customer loyalty. But a good customer service experience is what builds loyalty.
Great. So question for the audience, if you humor me here. So how many of you use upfront one price, no haggle pricing on your website for both new and used? Does that mean like literally nobody? Okay, yeah. I got to call my guy for that, right? That's fair. That's fair. But that alone is telling. I mean, you aren't pushing that top down one way or the other. So okay, good point. Good point. Other questions? Sheldon.
Let's discuss subscriptions. What's happening in that with the manufacturers pushing?
And is that vehicle subscriptions or feature subscriptions?
Time it's got a car,
Rear heated seats.
things like that, radios, whatever.
Okay, so let me kind of paraphrase. There's been a lot of talk, and some OEMs have experimented with this, unbundling features and trying to sell them to consumers on a monthly basis. Many OEMs, including Ford and GM, have got up in front of investors and said by 2030 they're going to generate $20 or $25 billion of new revenue annually from subscription services. Do you believe that's going to happen? And how do you think this is going to play out? I hope you're okay with my, okay, great.
I think there's certain things that it will work with, if level 2, level 3, advanced driver assist systems, you could probably, equip the vehicle with the hardware and then charge a subscription, $2,500 a year, whatever it winds up being for that service. But I don't think you can nickel and dime the consumer for every capability in the vehicle between, fuel, like Todd and I were just talking about, like, you can't program that the car tells you it's empty and there's 30 more, miles in the tank because you didn't pay for it, right? So
What do you think about Mercedes and Rivian saying you want to pay more for more range or more horsepower?
Yeah, I mean,
Is that nickel and diming, or is that something?
no, I think in those systems, but the thing is, in my mind, the consumer's already paying for the hardware, right? Because it has to be in there, right? So the software is just pure margin business anyway. So the consumer's really already paid for the capability to go, right? Because the battery's there. They paid for the battery. It's just that capability isn't fully there. So you're kind of arguably double paying for it. So I don't think the consumer will for everything. But if you don't need 300 miles of range and can you do with 200 miles of range if it saves you $400 a month, that may be a better situation. I wonder what happens with pre-owned vehicles, right? How do you write a residual on something that gets wiped clean? Because there's all these menu pricing things that I put in it that somebody else might not want, right? So I'm just not sure how you would value a used vehicle on trade-in or at wholesale, knowing that the next buyer has to go and re-up everything. Or if I bought it, do I own it, and do I bring it in my new car with me? So, not that these things can't be figured out, but I think it would be pretty messy, at least at first.
You guys have a perspective on?
I have one question, which is, okay, I come in, I buy a car, and I'm now spending $1,000 a month to get a car. And then the guy turns around to me and says, oh, but there's another $300 a month you have to pay to get all this good shit. It's like, I think that's a short-circuit way to get customers really pissed off at you. It's just my view as a consumer.
Tell us what you really think.
And the thing is,
I'm with a bunch of people who have no opinion. That's the problem. Car dealers are very passive folks.
but the thing is, you're also talking about the dealership being the customer facing, right? So if the manufacturer's doing this, and the consumer doesn't like it, the consumer is going to look at the dealership and say, why are you doing this?
Yeah, who are they going to blame at the end of the day?
What was for Jim Appleton? I mean, what isn't there resistance from the dealer associations to stop this? I mean, when I was involved with NADA, there was. I don't know where it is now. Were you guys successful in getting the automakers to not be able to bypass the dealers for this revenue?
Yeah, there have been some brand by brand negotiations. Mercedes was the first to agree to reimburse their dealers for subscription services. There's been some other discussions, and again, not to discount this because I think it's important. There is legislation in New Jersey that would prohibit subscription services. I'm not sure I like the idea of the legislature regulating this area. I think this is something it might shock some of the people in this room to hear me say this might be one of those things that dealers and manufacturers should work out away from the legislature. But again, like agency, online retailing, subscriptions, it's all an issue when you have one too few cars in inventory. But when you have one too many, all these issues tend to go away. I mean, you can just see at the showroom, the dealer's not going to be able to sell a subscription if they're trying to put a customer in a car. They're going to give it away. Floor mats, it's the digital version of, we'll throw in the floor mats if we do the deal today. So I don't think that I think subscription is one of those things that's going to work itself out in the marketplace between the automakers and the dealers, and it's not something that I expect to see the legislatures dealing with.
What I would say too, Steve, while you're going to do that, like what I tell dealers is I would actually be more concerned with the over-the-air update than with a direct or agency model, right? Because that's getting into your service bays where, that's where the margin is, right? So if you get to where all vehicles are software-derived vehicles now, and the consumer's not going to want to bring it in for something that can be sent over the air, and it squeezes the dealer. Now you don't get the wheel off and say hey, you have all these other services and things you need. As a dealer, I would be more concerned with where am I in this over-the-air update future than with the idea that I'm going to get squeezed out because the manufacturer's going to go direct to the consumer on new vehicle sales.
Great. Thanks, Kevin. We've got about 4 minutes left. I want to be respectful of time, and Andrew needs to close things up, including you getting your checks, most importantly, before we leave today. Other questions from the audience before I start doing a little bit of a speed round and wrapping? Oh, Andrea, yes.
I think I can talk loud enough.
You can't see.
So, based on the fact that the CPI came in slower, I think that's the right term, slower than expected, what do you think that means from the Fed? Because obviously that's impacting dealers' financial statements in terms of, if there are excess day supply and interest and so forth. That's probably one of the biggest single issues dealers have had in years past is that floor plan interest. So how do you think the Fed's going to react based on that lower than expected CPI?
I would say that the Fed has basically said that with the slower CPI, they're going to keep interest rates on on hold, interest rate increases. That's on one side of the ledger. On the other side of the ledger is the massive amount of government borrowing that's happening is crowding out and pushing the 10-year and up higher. So the Fed isn't necessarily having to increase interest rates by them. The market is increasing interest rates because of so much borrowing by the government and other sources. So I think interest rates are going to be flat, and if they start, so I think basically the market is doing the Fed's work for them.
Other thoughts? Kevin, you're like literally biting your lip.
No, I think I'm just not sure how much those issues get into the dealership or the manufacturer, on a month-to-month basis. But look, when inflation is high, when interest rates are high, it's usually a signal that the economy's hot, right? So yes, it costs more to buy a vehicle, but you're also getting more on your trade. Your house is worth more. Your raise is higher. So these things all move together. It's not, when gasoline goes up, everything's going up, right? So it's all relative in the sense that I don't think that the consumer is going, oh my God, the CPI was better or worse than I expected. Let me not buy this car or, do my Christmas shopping or whatever it winds up being. There's just a lot of moving parts in it. And look, even interest rates where they are now, and I'm no economist, they're historically high, but they're not high, right? They've just been so ridiculously low or zero for so long that we look at this and go, this is incredible. I know my first house was 8.5% mortgage. My parents was 19, and then and so we're in that range now where it's like this, we're not in that range, but you know what I mean? Like this is not really that bad historically speaking.
Any last questions before I do a little bit of a speed round to wrap? Okay, so just two questions. So put yourselves in the shoes of the folks in the audience. I may be a multi-generation owner with 10, 15 rooftops, whatever it might be. What's one thing that they should be focused on that they might not be focused on today? Anybody can go, because it might be a little bit of a curveball for you. If you were them, what would you be focused on?
Right now, estate planning. Because you don't want the government to take all the value you've created over your lifetime. And if your kids want to be in the business, it's estate planning.
And any general advice, where would you have them focus?
That's really for a tax advisor, and I'm not a tax advisor.
Okay, fair enough. Kevin, Jeremy?
I'd say be prepared that this market is going to be smaller than, the normal straight line growth that everybody forecasts in. That this is going to be a comfortable market, 15, 16 million unit markets, but with good profitability.
Okay, Jeremy?
And I think everybody's thinking about it already, but I would just emphasize expense reduction, making sure that your expenses are in check, especially because there is some uncertainty ahead. And then employee retention is just becoming a bigger and bigger and bigger, and it always was a big issue, but I'm hearing it more and more about keeping employees because the cost of turnover is just getting exponentially higher, and it's becoming harder to get people to want to do these jobs. So finding ways to keep your employees loyal is a great investment to make now for the future.
Great. So last question that I like to use at the end of panels, give us a little bit of insight into if you're actually a car guy or not. Help me understand the one that got away, either a car that you owned at one point that you wish you still owned, or a car that you had a chance to buy, but you didn't buy and now you regret it.
I always think of 2008 when the when the car market was crashing because of the financial crisis, and there were, at the time, the off-lease Mercedes E-Classes, the E500s, the eight-cylinders, which were selling at Manheim for like $15,000. With low miles, I regret I never bought one of those.
Great, good answer.
I went into a dealership once, and there was a Porsche.
What year? What year?
I don't want to say because I'm that old. There was a Porsche Carrera GT used that the guy priced, the guy on the floor mistook what the price was, and he, by under 10 grand, and rather than turn around and buy it that second, I waited 24 hours and they raised the price.
I've been fortunate to own what I want. I drove my V12 Mercedes here today. But I was in graduate school. I had just finished, and I would drive past this used car dealer every day, and there was a 1994 Pontiac Firehawk, which was the one that was sort of warmed over by SLP, the Ram Air Trans Am. And I jumped over the fence and I looked at it, and then when I graduated, I went and I bought it, but I sold it like 7 months later because we found out my wife was pregnant with our second child. So I traded it in on a minivan. But I told her, I traded in on a town and country minivan, and I told her, if that car ever comes up anywhere, if I ever see it in classifieds, I'm buying it and you can't say anything about it. And she said, okay, and I've never found it.
Okay, so now we know. Put the feelers out. Put the feelers. You get a finder see.
It was a white 6-speed.
Yeah, yeah. Okay, awesome.
What about you?
Well, so I was a kid. I grew up like in the 80s, and I had the Alpine Lamborghini Countach on the wall. And, you know, it's funny, 10 years ago, 12 years ago, I was at Auto Trader, and you could buy those all day long for like 40 grand on Auto Trader. And I did not buy it. Now that car is worth
like
$500,000 probably. In good condition, like 700 grand. So, but that's okay. I mean, at some point, I'll have the wherewithal to have a collection of Countaches, but.
So put the feelers out.
Yeah, put the feeler. Yeah. Maybe slightly different, like as a scale. But listen, thank you very much. Thanks to the panelists. Have a round of applause. And thank you for the engaged conversation. You can always tell, especially like with a bunch of type A's like all of you in the audience, when you actually stick around, you're either sticking around for the check or you're sticking around for the quality of the panelists. I believe it's the latter. For all three of you, if they want to get in contact with you, what's the best way to get in contact with you, Kevin?
I guess Google Kevin Tynan Bloomberg.
T-Y-N-A-N.
Correct. Like
Great.
Ronan Tynan, the Irish tenor.
Okay.
There you go.
Todd.
But you're better looking. Okay. Actually, just give me, you can either call me or just send me an email at tberko@belairpartners.com.
B-E-R-K-O.
Right, B-E-R-K-O.
Awesome. Jeremy.
And same thing for me. You could just Google my name. Last name is Alicandri, A-L-I-C-A-N-D-R-I.
Guys, you've been gentlemen today. Thank you for your time. Really appreciate it. Thanks. And with that, Andrea, she's already back at the mic.
Thank you.
Thanks, everybody. Appreciate it very much.
I can only say thank you, Steve. You did a wonderful job. And each of the panelists, we have a little remembrance of this day for each of you. Thank you again. And yes, the best way to work through this market is with Wasco because we're going to save you money. So if you want to save money, you should be coming to us, and we'll help you with that expense reduction and getting done what you need to get done, especially anything equipment or anything commodity, office furniture, office supplies. We do it all. So thank you again. On your way out, the ladies pretty much, I think, have things under control, and they'll have your checks. Please make sure you pick them up. And again, thank you for a wonderful time and for all your patience and attendance. We really appreciate it. Thank you.